1. A manufacturing entity in Dhaka values its year-end raw material inventory. Under IAS 2 inventories, which of the following costs must be explicitly excluded from the cost of purchase? Option 1. Import duties and non-refundable purchase taxes paid to the National Board of Revenue (NBR). Option 2. Abnormal amounts of wasted materials, labor, or other production overheads. Option 3. Inward transport, handling, and freight charges directly attributable to acquisition. Correct answer is abnormal amounts of wasted materials, labor, or other production overheads. 2. The draft accounts of a retail firm show a cost of goods sold (COGS) of 620,000 takas. It is later discovered that the opening inventory was overstated by 30,000 takas and the closing inventory was overstated by 10,000 takas. What is the corrected cost of goods sold? Option 1. 600,000 takas. Option 2. 640,000 takas. Option 3. 580,000 takas. Correct answer is 600,000 takas. 3. A trading enterprise has an opening inventory of 150,000 takas and purchases during the year of 800,000 takas. Goods costing 20,000 takas were withdrawn by the proprietor for personal use, and goods worth 30,000 takas were distributed as free samples. If closing inventory is 180,000 takas, calculate the cost of sales. Option 1. 720,000 takas. Option 2. 770,000 takas. Option 3. 750,000 takas. Correct answer is 720,000 takas. 4. During a prolonged period of steadily rising prices, inflation, an electronics retailer uses the FIFO method instead of the weighted average cost method. This measurement choice will result in: Option 1. A lower cost of sales and a higher reported gross profit. Option 2. A higher cost of sales and a lower ending inventory valuation. Option 3. A higher cost of sales and a higher reported gross profit. Correct answer is a lower cost of sales and a higher reported gross profit. 5. At the reporting date, a shipment of goods purchased on credit terms, FOB shipping point, is in transit. The supplier invoiced the goods on 28 December, but they physically arrive on the 5th of January. How should this be handled for the year-end financial statements? Option 1. Include the goods in year-end closing inventory and record the corresponding trade payable. Option 2. Exclude the goods from closing inventory since physical possession has not occurred. Option 3. Record the purchase transaction but do not include the items in ending inventory. Correct answer is include the goods in year-end closing inventory and record the corresponding trade payable. 6. A company's inventory at year-end has a historical cost of 450,000 takas. Due to market obsolescence, the estimated selling price is 420,000 takas, conversion costs to complete are 15,000 takas, and selling distribution costs are 10,000 takas. At what value should the inventory be presented in the balance sheet? Option 1. 395,000 takas based on the lower of cost and net realizable value (NRV) rule. Option 2. 420,000 takas based on the net replacement cost model. Option 3. 450,000 takas based on the historical cost principle. Correct answer is 395,000 takas based on the lower of cost and net realizable value (NRV) rule. 7. Under IAS 2, which of the following overhead allocations is strictly prohibited from being capitalized into the cost of finished goods inventory? Option 1. Variable production overheads based on actual usage of fabrication tools. Option 2. Fixed production overheads allocated using the normal operational capacity of the plant. Option 3. General corporate administrative overheads that do not contribute to bringing inventory to its present location. Correct answer is general corporate administrative overheads that do not contribute to bringing inventory to its present location. 8. A clothing depot in Chittagong performs a physical stock count on the 5th of January, finding inventory valued at 850,000 takas. Between the 31st of December year-end and the 5th of January, purchases were 60,000 takas and sales were 90,000 takas made at a standard markup of 25% on cost. Calculate the inventory value on the 31st of December. Option 1. 862,000 takas. Option 2. 880,000 takas. Option 3. 838,000 takas. Correct answer is 862,000 takas. 9. If a business changes its inventory valuation model from the weighted average cost method to the FIFO method, how must this change be implemented under Professional Accounting Frameworks IAS 8? Option 1. Retrospectively, by restating the comparative prior period financial figures and adjusting opening retained earnings. Option 2. Prospectively, applying the new formula only to inventory transactions occurring from the current date forward. Option 3. By recording a one-time adjustment option directly within current year finance costs. Correct answer is retrospectively, by restating the comparative prior period financial figures and adjusting opening retained earnings. 10. An entity reports sales of 1,200,000 takas and maintains a uniform gross profit margin of 30% on sales revenue. If opening inventory was 200,000 takas and purchases were 900,000 takas, what is the value of the closing inventory? Option 1. 260,000 takas. Option 2. 360,000 takas. Option 3. 140,000 takas. Correct answer is 260,000 takas. 11. A furniture manufacturer uses expensive timber logs to create unique designer tables. Which inventory costing methodology is the most appropriate and compliant under IAS 2 for these specific items? Option 1. Specific identification method. Option 2. First in, first out FIFO method. Option 3. Weighted average cost formula. Correct answer is specific identification method. 12. A firm discovers that its closing inventory for year 1 was understated by 50,000 takas. If this error remains completely uncorrected, what is the impact on the net profit of year 2? Option 1. Net profit for year 2 will be overstated by 50,000 takas. Option 2. Net profit for year 2 will be understated by 50,000 takas. Option 3. Net profit for year 2 will be perfectly accurate because the error self-corrects over time. Correct answer is net profit for year 2 will be overstated by 50,000 takas. 13. While calculating the cost of a stock lot, an accountant includes storage costs incurred for holding semi-finished goods that require a further mandatory aging stage before final processing. Is this inclusion valid under IFRS? Option 1. Yes, storage costs necessary in the production process prior to a further production stage are capitalized. Option 2. No, all storage and warehousing costs are strictly treated as period expenses under IAS 2. Option 3. Yes, provided the total storage cost does not exceed 10% of the raw material invoice value. Correct answer is yes, storage costs necessary in the production process prior to a further production stage are capitalized. 14. Given, sales 900,000 takas, gross profit ratio is 25% on cost of goods sold COGS. Calculate the absolute value of the cost of goods sold. Option 1, 720,000 takas. Option 2, 675,000 takas. Option 3, 750,000 takas. Correct answer is 720,000 takas. 15. A wholesale trade entity purchases 1,000 units of a product at 100 takas per unit. The supplier provides a 10% trade discount on the invoice. The entity pays 5,000 takas for freight insurance and 2,000 takas to local labor for unloading. What is the total cost per unit for inventory mapping? Option 1, 97 takas per unit. Option 2, 107 takas per unit. Option 3, 90 takas per unit. Correct answer is 97 takas per unit. 16. When goods are sent to a customer on a sale or return approval basis, they should be included in the closing inventory of the sending firm at Option 1. Their manufacturing or acquisition cost value, until the customer formally signals acceptance. Option 2. Their expected retail selling price, since control has physically shifted to the client. Option 3. Nil value, because a conditional sales transaction has already been logged in the day books. Correct answer is their manufacturing or acquisition cost value, until the customer formally signals acceptance. 17. A company writes down its slow-moving inventory from cost to net realizable value by 40,000 takas at year-end. How should this adjustment be disclosed in the financial statements? Option 1. Recognized as an expense within cost of sales in the statement of profit or loss. Option 2. Debited directly to retained earnings without passing through the current year's profit performance. Option 3. Presented as a separate non-current liability line item on the balance sheet face. Correct answer is recognized as an expense within cost of sales in the statement of profit or loss. 18. Which of the following data structures is directly used to calculate the cost of goods manufactured in a comprehensive financial schedule? Option 1. Direct materials consumed plus direct labor plus factory overheads plus opening WIP, closing WIP. Option 2. Opening finished goods plus purchases plus freight inwards, closing finished goods. Option 3. Sales revenue, gross profit margin deductions, administrative allocations. Correct answer is direct materials consumed plus direct labor plus factory overheads plus opening WIP, closing WIP. 19. If a commodity business has an inventory turnover ratio that drops severely from 8.5 times to 3.2 times during the current audit window, it indicates. Option 1. Slower sales or overstocking, which flags a high risk of inventory obsolescence requiring an NRV write-down. Option 2. Rapid product movements and higher liquidity metrics across retail stores. Option 3. An increase in the total profit margin performance per unit sold. Correct answer is slower sales or overstocking, which flags a high risk of inventory obsolescence requiring an NRV write-down. 20. Byproducts generated during chemical manufacturing possess immaterial value. Under standard inventory frameworks, how are these items treated? Option 1. Measured at net realizable value and deducted from the core cost of the main product line. Option 2. Allocated a proportional share of fixed factory overheads based on volumetric weight. Option 3. Ignored completely and treated as waste with zero financial data tracks. Correct answer is measured at net realizable value and deducted from the core cost of the main product line. 21. A retailer in Khulna has an opening inventory of 90,000 takas, purchases of 430,000 takas, and a closing inventory of 110,000 takas. If carriage outward is 15,000 takas and carriage inward is 20,000 takas, what is the cost of sales? Option 1. 430,000 takas. Option 2. 445,000 takas. Option 3. 410,000 takas. Correct answer is 430,000 takas. 22. Why does IAS 2 inventories strictly prohibit the use of the last in, first out LIFO method for financial reporting? Option 1. It generally understates or distorts the value of ending inventory on the balance sheet during inflationary trends. Option 2. It makes the mathematical computation of the trial balance totals completely impossible. Option 3. It shifts the categorization of inventory assets from current items to non-current structures. Correct answer is it generally understates or distorts the value of ending inventory on the balance sheet during inflationary trends. 23. If a company uses a periodic inventory system instead of a perpetual inventory system, the ending inventory value is established primarily by Option 1. Performing a physical stock count at the exact conclusion of the accounting period. Option 2. Maintaining a continuous updated ledger tracking record of all inward and outward item clips. Option 3. Applying a fixed statistical percentage against total sales revenues. Correct answer is performing a physical stock count at the exact conclusion of the accounting period. 24. A business entity treats its inventory insurance premiums paid for protecting goods inside the primary commercial warehouse as an Option 1. Operating expense period cost in the statement of profit or loss. Option 2. Capitalizable inventory expense added into the unit production cost matrix. Option 3. Direct adjustment leg inside the statement of changes in equity schedules. Correct answer is operating expense period cost in the statement of profit or loss. 25. An auditor discovers that a lot of finished goods worth 75,000 takas was completely omitted from the closing stock sheet totals. Rectifying this inventory tracking omission will: Option 1. Decrease the cost of sales and increase both gross profit and current assets. Option 2. Increase the cost of sales and decrease current reporting equity metrics. Option 3. Have zero operational impact on the calculated net profit outcome. Correct answer is decrease the cost of sales and increase both gross profit and current assets. 26. When allocating fixed production overheads to inventory units, what happens to unallocated overheads if actual production is significantly lower than normal capacity? Option 1. They are recognized as an expense in the period in which they are incurred. Option 2. They are capitalized into ending inventory by increasing the unit cost metric. Option 3. They are deferred on the balance sheet as a prepaid non-current asset component. Correct answer is they are recognized as an expense in the period in which they are incurred. 27. A company sells goods with a cost of 60,000 takas for 80,000 takas cash. What is the dual impact of this individual transaction on the components of the financial statements under a perpetual framework? Option 1. Inventory decreases by 60,000 takas, cash increases by 80,000 takas, retained earnings increase by 20,000 takas. Option 2. Cash increases by 80,000 takas, sales revenue increases by 80,000 takas with no stock ledger entry changes. Option 3. Inventory decreases by 80,000 takas, retained earnings decrease by 20,000 takas. Correct answer is inventory decreases by 60,000 takas, cash increases by 80,000 takas, retained earnings increase by 20,000 takas. 28. An enterprise has 500 units of stock. The original cost is 200 takas per unit. It will cost 30 takas per unit to repackage them for sale. The expected market price is 220 takas per unit. At what value should the total lot be written down? Option 1. 95,000 takas based on an NRV of 190 takas per unit. Option 2. 100,000 takas based on the original cost historical layout. Option 3. 110,000 takas based on gross expected revenue outcomes. Correct answer is 95,000 takas based on an NRV of 190 takas per unit. 29. Which of the following inventory components is explicitly valued under a different accounting standard instead of IAS 2 inventories? Option 1. Biological assets related to agricultural activity at the point of harvest. Option 2. Raw components and steel parts held by an automotive vehicle assembly line. Option 3. Finished goods items packed in boxes waiting for shipment to wholesalers. Correct answer is biological assets related to agricultural activity at the point of harvest. 30. If a company overstates its opening inventory for the current year by 45,000 takas and understates its closing inventory by 15,000 takas, what is the net effect on the calculated gross profit? Option 1. Gross profit is understated by 60,000 takas. Option 2. Gross profit is understated by 30,000 takas. Option 3. Gross profit is overstated by 60,000 takas. Correct answer is gross profit is understated by 60,000 takas. 31. A trading company buys goods from an international supplier. Which of the following elements can be capitalized into the inventory cost structure? Option 1. Demurrage and port handling penalties due to delayed customs clearing documentation. Option 2. Clearing agent commissions and legal port fees required to release the cargo. Option 3. Foreign exchange translation losses incurred due to currency shifts after delivery. Correct answer is clearing agent commissions and legal port fees required to release the cargo. 32. Under the Perpetual Inventory Tracking Framework, the matching journal tracking entry passed immediately upon a credit customer returning traded stock is: Option 1. Debit inventory AC, credit cost of sales AC, alongside the sales reversal entry. Option 2. Debit cost of sales AC, credit inventory AC, with zero other adjustments. Option 3. Debit purchase returns AC, credit trade receivables structure. Correct answer is debit inventory AC, credit cost of sales AC, alongside the sales reversal entry. 33. An entity uses the weighted average cost method periodic. Opening stock, 100 units at 10 takas. Purchase 1, 200 units at 12 takas. Sale 1, 150 units. What is the average unit cost used to value the closing stock at month end? Option 1. 11 takas and 33 paise per unit. Option 2. 11 takas per unit. Option 3. 12 takas per unit. Correct answer is 11 takas and 33 paise per unit. 34. If a factory experiences normal evaporation or structural shrinkage of raw materials during its production loop, how is this loss accounted for? Option 1. Absorbed into the cost of the remaining good units of production inventory. Option 2. Expensed separately as an extraordinary item in the statement of profit or loss. Option 3. Charged as a reduction entry within long-term capital reserve columns. Correct answer is absorbed into the cost of the remaining good units of production inventory. 35. A company has a gross profit ratio of 40% on cost. What is the equivalent gross profit margin ratio expressed as a percentage of sales revenue? Option 1. 28.57%. Option 2. 40.00%. Option 3. 66.67%. Correct answer is 28.57%. 36. When raw materials are transferred from the central warehouse floor to the factory floor to begin production, the double entry inside a cost management framework is: Option 1. Debit work in progress WIP control account, Credit raw materials control account. Auction 2. Debit finished goods ledger, credit purchases ledger account. Auction 3. Debit factory overheads account, credit work in progress asset columns. Correct answer is debit work in progress WIP control account, credit raw materials control account. 37. An enterprise values its inventory at the lower of cost and NRV on an item-by-item basis. Why is this specific granularity preferred over the global aggregate basis? Auction 1. It prevents profits from one item group from obscuring or offsetting losses from another item group, adhering to prudence. Auction 2. It simplifies the mathematical calculation tasks for the software automation modules. Auction 3. It ensures that the ending inventory value perfectly matches the replacement cost track. Correct answer is it prevents profits from one item group from obscuring or offsetting losses from another item group, adhering to prudence. 38. A company's inventory count shows a balance of 300,000 takas. This includes items costing 40,000 takas held by the company on consignment from an external manufacturer. The correct inventory figure for the balance sheet is Auction 1. 260,000 takas. Auction 2. 300,000 takas. Auction 3. 340,000 takas. Correct answer is 260,000 takas. 39. If an entity treats outward freight charges delivery to customers as a component of cost of sales, it represents a structural misclassification because outward freight belongs under Auction 1. Selling and distribution expenses. Auction 2. Administrative and general overheads. Auction 3. Cost of purchases inside trading loops. Correct answer is selling and distribution expenses. 40. A company's sales revenue is 1 million takas and its cost of sales is 600,000 takas. If operating administrative expenses are 150,000 takas, what is the gross profit margin percentage? Auction 1. 40%. Auction 2. 25%. Auction 3. 60%. Correct answer is 40%. 41. A firm purchases a specialized raw material compound. The supplier provides a 5% volume rebate if purchases exceed 10,000 liters a year. The firm reaches this threshold. How is this rebate accounted for under IAS 2? Auction 1. Deducted from the purchase cost of inventory, reducing the cost of sales or ending stock. Auction 2. Recognized as other operational income on the face of the income statement. Auction 3. Credited directly to capital reserves to help with equity balancing tasks. Correct answer is deducted from the purchase cost of inventory, reducing the cost of sales or ending stock. 42. If a retail business fails to write down its inventory units that are physically damaged and unsellable, how does this affect the current period's financial statements? Auction 1. Current assets are overstated, and net profit is overstated. Auction 2. Current assets are understated, and net profit is understated. Auction 3. Current liabilities are understated, and equity remains unchanged. Correct answer is current assets are overstated, and net profit is overstated. 43. Given, opening inventory 60,000 takas, closing inventory 80,000 takas, purchases 500,000 takas. Calculate the inventory turnover ratio for the year if cost of sales is 480,000 takas. Option 1. 6.86 times, based on an average inventory of 70,000 takas. Option 2. 6.00 times, based on ending inventory figures. Option 3. 7.14 times, based on opening stock values. Correct answer is 6.86 times, based on an average inventory of 70,000 takas. 44. Under standard manufacturing accounting, interest and borrowing costs are explicitly excluded from inventory valuation unless the inventory items are. Option 1. Qualifying assets that take a substantial period of time to get ready for their intended sale IAS 23. Option 2. Valued exclusively under the specific identification method framework. Option 3. Imported through international trade agreements requiring letter of credit tracks. Correct answer is qualifying assets that take a substantial period of time to get ready for their intended sale IAS 23. 45. A business records its transactions using a periodic framework. At year-end, the entry passed to bring closing inventory into the general ledger system is. Option 1. Debit closing inventory asset credit trading account or cost of sales. Option 2. Debit trading account, credit closing inventory asset. Option 3. Debit purchases account, credit closing inventory ledger. Correct answer is debit closing inventory asset credit trading account or cost of sales. 46. Which of the following items is included in the net realizable value formula as a deduction from the estimated selling price? Option 1. The estimated costs of completion and the estimated costs necessary to make the sale. Option 2. The original import duties paid at the port of entry during acquisition. Option 3. The proportional fixed factory overheads calculated using normal plant capacity. Correct answer is the estimated costs of completion and the estimated costs necessary to make the sale. 47. If an entity overstates its closing inventory for year 1, what will be the structural distortion on the financial metrics of year 1? Option 1. Cost of sales is understated, and gross profit is overstated. Option 2. Cost of sales is overstated, and gross profit is understated. Option 3. Both cost of sales and gross profit are overstated concurrently. Correct answer is cost of sales is understated, and gross profit is overstated. 48. Under a perpetual inventory framework, a physical inventory count reveals a shortage of 10,000 takas compared to the book records due to minor pilferage. The required adjustment entry is. Option 1. Debit inventory shortage expense or COGS credit inventory account. Option 2. Debit inventory account, credit suspense account tracking columns. Option 3. Debit purchases account, credit inventory loss ledger files. Correct answer is debit inventory shortage expense or COGS credit inventory account. 49. An entity sells luxury sports cars. Under inventory classification rules, these vehicles must be presented as Auction 1. Current assets under inventories, because they are held for sale in the ordinary course of business. Auction 2. Non-current assets under property, plant, and equipment, due to their high unit cost value. Auction 3. Investment properties, because their market value might appreciate over time. Correct answer is current assets under inventories, because they are held for sale in the ordinary course of business. 50. If the ending inventory of a firm is 0 at the end of a perfect trading period, its cost of goods sold value will equal Auction 1. Opening inventory plus net purchases for the period. Auction 2. Net purchases minus opening inventory balances. Auction 3. Total sales revenue minus the gross administrative expenses. Correct answer is opening inventory plus net purchases for the period. Quiz completed successfully.